Today, we're going to be taking a look at tax you might be liable to any dividends or savings interest you receive. With higher interest rates, the number of people due to pay tax on savings has increased. I'll be covering UK taxes only and will not be looking at any sort of capital gains tax today. First up is dividends, which are, of course, payments you receive from companies you own shares in. Tax rates are based on what income tax bracket you fall into, whether that's basic, higher, or additional tax rate. Regardless of the applicable rate, all individuals are entitled to a dividend allowance, meaning they can earn up to the allowance tax-free. This is currently sitting at £1,000 for the 23 to 24 tax year. This has dropped from £2,000 the previous tax year, and more importantly, this has been cut in half again for the 24-25 tax year to £500. If your yearly dividends are below the allowance, you do not need to contact HMRC about how much you've earned. Looking at specific examples of how much and how many shares you can own in these companies before exceeding your dividend allowance. In orange is the current tax year using the £1,000 allowance, and below is the next tax year with half the allowance. So a company like Greencoat UK Wind, that is paying a forward dividend yield of 7.45%, you can only own £13,000 worth of shares, which is roughly 10,000 shares, before you will owe HMRC tax on dividends received above this allowance. I recently posted an update to UKW, so be sure to check that out to see why the yield is so high. Other UK company GSK, which I've done a stock analysis video on before, is currently paying a yield below 4%. And Unilever, slightly below GSK, is a company I'm looking to do analysis on soon. Now, ATT is slightly different as it's a US company. Dividends once received are treated similarly to UK ones. However, before receiving, a 15% withholding tax is taken off, so yield is less. Number and value of shares you own can fluctuate based on exchange rates. It's worth noting that your personal allowance can also apply to dividends. So if your salary or income from other sources is below £12,570, your remaining tax-free allowance can be used on your dividend income. So once you are earning above this threshold, the following rates apply. 8.75% for basic rate, 33.75% for higher rate, and 39.35% for additional rate. One key thing about these rates is that they are lower than income tax rates for each bracket, with the difference reducing as you move up the tax rates. Tax is only due on the amount you earn above the threshold, not the total amount received. For stocks and shares you're receiving dividends on above the allowance, you should look to move shares into a stocks and shares ISA. This way, any dividends will be earned tax-free. Of course, you can't do this with all shares, and there are limitations on ISAs. Next, we'll take a look at savings. Savings income includes, of course, bank interest, but also interest from distribution from various investment trusts, income from government and corporate bonds, and also life annuity payments. Savings income is treated separately to dividends, and it has its own dividend allowance. So similar to dividends, there is a savings allowance which allows you to earn interest tax-free. However, the applicable threshold is dependent on your income tax bracket. The tax-free allowances are £1,000, £500 and £0 if you're a basic, higher or additional tax rate payer respectively. So unlike dividend allowance, your tax-free rate decreases as your income increases. Also, unlike dividends, savings are taxed at the income tax rate, so that's 20, 40 and 45% rather than the reduced dividend rate. Now, the majority of basic rate taxpayers, there will be very few which are liable for tax. The best easy access savings account at the time of recording is paying 5.22% interest. You would need to have over £19,000 in this account for the whole year to exceed your £1,000 allowance, assuming there's no other savings income. However, for higher rate payer, this amount is cut in half. So anything over £9,500 would cause you to pay tax, and this tax would be at 40%. Additional tax rate payers would need to look at alternatives, either something that instead pays dividends, so they have the dividend allowance, or a tax-free account like an ISA. Generally speaking, non-ISA accounts pay a higher rate of interest than ISA accounts, so they are best to go for unless you're exceeding this allowance. Then anything above this allowance should be moved to an ISA. This is assuming the rate available in the ISA is not paying less than would be received from a non-ISA account, even when paying the tax. Using the current 5.22% easy access, you would need an ISA to pay at least 4.18% as a basic rate taxpayer. or 3.13% as a higher taxpayer, or a 2.87% rate as an additional rate taxpayer. Of course, there are currently plenty of ISAs that pay above these rates. With ISA rates generally being lower, however, I would not just stick all my money in an ISA. Another issue is you can only pay into one cash ISA per year. So if you're stuck into a lower paying account, it might be worth moving to a non-ISA account if rates are below the applicable rates I've just mentioned, or you fall within the savings allowance. The last thing I want to touch on for savings is the starting rate for savings. So similar to dividend, but if your income falls below the personal allowance, any remaining allowance can be used and applied to savings interest. In addition to this, there's also something called a starting rate for savings. This is a £5,000 allowance for anyone earning below the personal allowance. This £5,000 reduces by £1 for every pound you earn over £12,570. So someone with zero other income can earn up to £17,570 interest tax-free. Or if someone earns the exact personal allowance of £12,570, they can earn another £5,000 tax-free from savings. As a majority of people earn over £17,570, or if they don't, they aren't earning large amounts of interest. This only applies to few people with little to no income and a very large interest income, such as retired individuals, particularly those with life annuity policies. REITs or real estate investment trusts pay out income they receive to shareholders. These payments are treated slightly differently. Payments can be classed as property income distributions, or PIDs. They are treated as regular income, and only personal allowance can be used to prevent tax. These PIDs are taxed 20% before you receive them, so if you're a basic rate taxpayer, there's no further tax for you to pay. Higher and additional rate taxpayers have a further liability of 20 and 25% respectively. Payments from REITs can also be classed as non-PIDs, which means they are treated the exact same as normal dividends. The advantages of PIDs is that they are more tax efficient for the trust overall, even if the individual investor is required to pay a higher tax. Thanks for watching. Please like and subscribe, and why not check out one of my other stock analysis videos or a stock market basic video.